Contrary to popular belief, the buy and hold strategy isn't a one-size-fits-all investment and has many flaws. In fact, it's a myth that the buy and hold strategy is the best strategy that exists out there for your investing needs. If you're looking to buy a house in the next 5 years, if you're looking to get married, maybe you might have a divorce, if you're looking to retire in the next 10 years, any of these things coming up, the buy and hold strategy might not be right for you. Hey everyone, I'm Mike Rosehart. Welcome back to my channel. Hope you're having a great day today. We're going to talk today about why the buy and hold strategy doesn't hold water if you dig deeper for all situations, specifically talking about investing in stocks and in real estate and businesses. So most people, they think that when you buy an asset like a rental property, that you should buy and hold it forever. And on the surface, they aren't wrong. In fact, the academic studies and data suggest that if you hold a portfolio of stocks for over 20 years or a collection of real estate properties or any asset that exists, over a long period of time, you will have gains. You'll have profit. And in fact, you will have large profits. And so by buying and holding, you can make any investment a good investment. And at the surface, they're right. It's true. But the buy and hold strategy has many flaws that you aren't aware of, and we're going to talk about those flaws today. The buy and hold investing strategy has many flaws that we need to dive into today, and why I believe the buy and hold real estate and stock investing strategies both are not the best way to go. Now, I'm a buy and hold investor. People know that I like to buy and hold a lot of my rental properties, a lot of my stocks and things like that, but I do not subscribe to buy and hold forever. Buy and hold implies that there is no risk management. It implies that price doesn't matter. It implies that you can basically buy at any price and it doesn't matter, but that's mathematically impossible. And I'm going to go into on the whiteboard in a little bit here why it doesn't always make sense to buy and hold. And everyone knows all of my stocks, all of my businesses, all of my real estate is always for sale. I'm always evaluating in my portfolio what doesn't fit. If something appreciates beyond the rent cap rate that I'm expecting, I will sell it and buy something at a better cap rate. If my properties are now at market value, they could sell at a 6 cap rate. If I can sell at a 6 cap rate and then go buy at an 8 cap rate and add more value to the next property, I will sell my properties. Buying and holding properties forever is a bad idea. Buying and holding stocks forever is a bad idea. You should rebalance your portfolio. It is a smart thing, a prudent thing to do. Buy and hold also assumes that over the long term, you're going to get better returns. That's also not entirely true. You can, in fact, time the market. There are people out there who invest prudently, and when the market is high, sell and then buy back in and dollar cost average and get a better return than someone who just holds a stock forever. Same is true, especially in real estate. You should not hold your rental properties forever. That is a myth. It's one of the biggest things that I see people come to me in real estate investing sessions and they justify overpaying for properties, they justify over-renovating, they justify all the bad decisions with a buy and hold approach. That's okay, I'm gonna do X and Y renovation. I don't care what the resale is. I don't care about the cash flow. I care about, long-term, I'm gonna make money on this. And you're gonna make money no matter what long-term. So it's basically an irrelevant justification for the bad decisions that you're making. If you can sell your property for an exorbitant amount of profit and then move that profit into another property that has a much better cap rate, you're going to make a lot more money. The same is true with stock investing. If you can sell Apple shares at $1,000 a share because it's at the peak that it's ever been, and buy a competitor for $100 a share, you may end up much better off. It makes sense to sell off some of your gains, take some of those, harvest them, and then reinvest. It does make sense to rebalance your portfolio. I want to illustrate a concept of where I think it's really important from a risk management and a time horizon perspective, because a lot of people get into buying and holding with the wrong goals in mind. And I think certain investors' goals might not make a lot of sense with a buy and hold strategy. The buy and hold strategy works really well if your time horizon is extremely long, as in you can hold for a really long time, and assuming you're buying diversified portfolios of equities or properties. But when you're buying, for instance, a single stock, or you're picking individual stocks, or you're buying properties, and you're buying specific rental properties or real estate, this buy and hold strategy is flawed inherently. Let's look at an example. So let's pretend this is the price of your house over time. You've got on one side price, got on one side time. As time goes on, we know there's a trend line. Things tend to go up over time in general. Now, not all properties, not all stocks. Some stocks, they go right to zero. And there was an optimal time to sell them, which the buy and hold strategy would prove is wrong. And they would argue through diversification, the proponents of the buy and hold strategy fans would argue that over the long term, with diversification, these one-time losses or flat stocks or properties would balance out. And I don't disagree. Diversification does protect your risk. But let's think through another flaw of the buy and hold strategy. Imagine if your goal was to buy a house in 5 years. Imagine if your goal was to get married in 3 years. Imagine if your goal was to retire in 5 years. Or imagine something else like a big trip. Now, if your time horizon doesn't align to the investing strategy, you're going to have problems. Most people's time horizon doesn't match up to what they're investing in. And whenever I build a financial plan or a FIRE plan for all of either myself or anyone I work with, I tell them it's important to think about what is your risk profile. Some people can't sleep at night with a 10% loss. It keeps them up. They're sweating all night long. They have a different risk profile than someone else. And that would affect what you invest in and how you invest in that equity or in that asset allocation. The same is true for the time horizon. You could imagine a situation where, let's just pick an example. Let's say the market's been roaring. Like you can imagine, 2009 to now. You buy said stock. You buy said property for X price. We'll call it here. And it goes well. The next year, things go well. And then we go into a bear market and things come down, things correct. You see a bit of a drop. We're thinking, 2006, 2009. We're talking the 90s to early 2000s. We're talking late 80s to early 90s when we had a bit of a cool down. In fact, like every decade ever. So business cycles suggest this will happen again. And you buy it. And you decide in 6 years you're gonna have your wedding. And guess what? You need access to that investment, cash, in order to have your wedding. So now you have to sell. But you're like, hey, I'm a buy and hold investor. I got 6 years. I'm gonna buy a bunch of stocks because Mike says buy and hold's great, which I do. I love the buy and hold strategy, but not by itself. I like to pair it with other strategies like the arbitrage strategy. And I also believe that there's a good time to sell. But you can imagine selling at a low point in the market. 7 years later, you could have 7 years and have no growth. You've lost money to inflation even. Now you have to sell, you're getting married, you're buying that house. Your wife, you promised her 6 years ago, you'd buy a house this year. Or maybe you've got that big trip planned. Maybe you have to retire. Uh-oh. You didn't take some of the gains off the table because you're a buy and hold investor. You held. You had a chance to sell your property for max dollars and take some of the profit and roll it into something else. You didn't. You held. And 7 years later, you end up exiting for a loss. That's a risk and a flaw of the buy and hold strategy. Now, if you actually have the time horizon that you can hold forever, like you're not going to retire for 25 years, that's a great use of capital for the buy and hold strategy. Over the long term, diversified, you will get great returns. I'm a fan of the ETF strategy. Long term, I believe in it. But if you're investing in 2019 right now, and you're going to pull any of that money out to buy a house, to go on a trip, to get married, to retire in the next 4 or 5 years, might not be a good thing to believe the buy and hold strategy is the be all end all. And if you look into the data, you'll see that mathematically, there is a best time to sell. Mathematically, you can theoretically time the market. You could theoretically harvest gains. You could theoretically also arbitrage, and especially in real estate, where you can buy property for 80 cents on the dollar, for 70 cents on the dollar. It's possible, it's doable. And so because that exists, the buy and hold strategy is inherently flawed. When we click back to the other clip, you'll see more about what I'm talking about. But the idea is that, my point is this, life gets in the way. And life gets in the way of the buy and hold strategy. So, bottom line, I like the buy and hold strategy, but don't be afraid to sell. If your portfolio is up 300%, if you have properties that have doubled in value and rents are still, around the same as what they were before, your cap rate's terrible. If you own a property in Toronto or Vancouver or New York or LA right now and your cap rate's 4, you should probably sell that property and buy something else. This is the reason why you watch videos I did a year or 2 years ago. In 2017, I sold like 11 of my properties off. Why? The market was at an all-time high in London. I made a mistake in that if you looked back with a crystal ball and used hindsight, the market went even higher than when I sold. But when I sold, I didn't sell at the highest point possible. I sold at a high. It was at a peak. I sold for a good amount of profit. I made a lot of money selling my 11 properties off. I reinvested that capital into more properties. Today we have over 55 properties. I wouldn't have that today if I didn't sell back and rebalance my portfolio. I said, hey, I got properties here that are generating me like 10 and 12% return. I had a ton of equity in these properties. It didn't make sense to hold. I couldn't refinance the capital out. It made sense to sell. I use in my real estate portfolio, I look at rebalancing every single year and identify, hey, this property doesn't fit. This market's appreciated a ton. Rents are still relatively flat here. I'm gonna sell and buy in a different area in my city, etc. and so forth. Or this property's been renovated to top dollar. It now is like an A-level property. It could sell for top dollar. I can sell that and buy something else that's more distressed and add more value. Keep my money moving. Keep growing that wealth. That's an important strategy, and I talked about that on the channel here, that buy and hold's great, but don't be afraid to sell your property. Don't be afraid to say, hey, it's time to rebalance. Whether you're in real estate, whether you're in stocks, the buy and hold strategy inherently has some flaws. And I think no one's addressing this on YouTube, so I made a video about it. I'm like, geez, I can't find anyone talking about how the buy and hold strategy sucks, how exchange traded funds might not be the be all end all, how it is possible that the simplest strategy isn't always the best one. Though I do like the buy and hold strategy, I do like diversified buy and hold strategies, there is a time to look and say, hey, how does this investment strategy align to my risk profile? What's my risk tolerance? And more importantly, how does this align to my time horizon for the goal? So when you're investing for a goal, you have to say, hey, I need this money in 3 years. It might not make sense to put it in equities, especially a buy and hold strategy with equities, because I'm gonna need to sell this in 3 years or 5 years. So think ahead, build it into your fire plan, and you'll be a lot further ahead than if you hadn't. And if you're liking the buy and hold strategy and you're a noob investor just getting started, there's nothing wrong with that strategy. So the buy and hold strategy is inherently flawed in that it assumes that an asset has a certain return and the risk is the same commensurate to that return. That's a flaw. It's like how people say you get what you pay for. They believe that you can buy a house for $250,000 and that all the houses at that price point are the same. That's not true. You can go buy a $250,000 house for $150,000. Off market, you might have to add some value to it. There may be some, arbitrage in that there's no pictures or photos or bad descriptions or just bad marketing in general. But the point is markets aren't efficient. So therefore, the buy and hold strategy isn't always the best investing strategy. You could use an arbitrage investing strategy wherein you could use tips from realtors to buy deals off market, or contact wholesalers to buy deals off market, or you could go and do research on stocks and buy stocks that are underpriced. The market does not know how to effectively price assets. And the buy and hold strategy assumes that when you buy an asset that all of the risk is the same, and risk is not the same. If you're buying a house worth $250,000 today for $150,000, your risk to reward profile is entirely different than just buying a $250,000 house for $250,000. In the earlier rather than the later, you have $100,000 upside if the market corrects. You have an instant gain of equity that protects you over the long term. And in fact, if that house then appreciated to a $400,000 price point, you had a good offer to sell it, you should go ahead and take that opportunity to sell it and buy something else again at $250,000 that would have a similar rent. Imagine you could sell your property for $400,000 now and buy something else in town for $250,000 that has the same rent. That's a huge win. Your cash flow is much better. You've pulled out a ton of equity. A lot of investors, they just don't understand that basic concept. The allure of the buy and hold strategy is simplicity. Like an idiot who has no idea about anything ever. By the way, I often recommend the buy and hold strategy to people who are unsophisticated investors, people who don't understand the stock market, who don't understand financial statements. Same is true for real estate investing. For someone who doesn't understand how to get a good deal on a property, how to add value to a property, the buy and hold strategy on its face is actually good. It's better than trying an arbitrage strategy when you're not an expert. My argument is this: if you can learn to be better than the market, which is possible, or you can learn to rebalance your portfolio and put a little bit of effort in, you can get a better return than the buy and hold strategy in and of itself. And time horizon, we're gonna talk about in a minute here on the whiteboard, how time horizon can affect you negatively with a buy and hold strategy. You need to align the investment with the goal. If you want to buy a house in 5 years and you buy stocks right now, where we're in late 2019 in a bull market, the last 10 years we've had a strong bull market, right? A decade of solid growth. We may go into a bear market. We may have a recession, right? For the next 5 years. And then when you go to buy that house or whatever that goal is in 5 years, that big trip, that wedding, whatever it is, you're gonna have to sell maybe at a 30% loss. So you have to time what you're investing in, the asset class, with the timeline that you need for cashing that out. A buy and hold strategy isn't always prudent. Like an equities buy and hold strategy might not be prudent, because then if your time horizon is exactly 5 years, you're now at the mercy of the market, right? And where the buy and hold strategy does work well where you have a long time horizon. So we'll get into that in a second here. But so one of the flaws, or almost like a myth of the buy and hold strategy, that proponents of a buy and hold strategy, which I am actually a proponent of the buy and hold strategy, but today I'm talking about some of the flaws with it. Proponents of the buy and hold strategy will often cite great ETF or index fund returns on a portfolio. And they say, hey, the buy and hold strategy works so well. Look, if you buy and hold something forever, you have great returns. And they point to the S&P 500. But if you dig a little bit deeper, what you find is that the S&P 500 and the ETFs aren't employing a buy and hold strategy. The S&P 500 drops stocks that don't perform. The S&P 500 drops stocks that don't perform. If you look at the S&P 500 index, companies are dropping off and on the index all the time. Companies like Facebook and Apple didn't even exist 30 years ago. So these are all new companies on the index. And when a company stops performing, it gets booted off the index. The same is true for an exchange traded fund. They aren't using a buy and hold strategy to give you your returns. They're actually rebalancing their portfolio, which by definition requires you not to buy and hold. It requires you to sell and rebuy. And so that's a different strategy than a buy and hold. So the buy and hold strategy avoids or sort of discounts the defensive side of investing. It's smart to cut your losses. It's smart to harvest gains when you've had a property that, pops off, right, and does really well, or same with a stock. That's prudent. But a buy and hold strategy would say, no, I'm just going to hold because in 20 years it'll be better than it is today. And that's true, but it could be even better had you sold and reinvested those profits in something else. So it's not the most optimal strategy for you. It is a simple one. It is an idiot-proof strategy. Any idiot can buy any house at any price and justify anything that they do to the property and probably make money over 30 or 40 years. Now, inflation adjusted, maybe not. But the point is there that everyone uses a buy and hold strategy to look smart when it's the simplest, and that's the attraction. Everyone wants to make money for no effort. Everyone, I want it too. Like, I'd love to make tons of money for no work. It just doesn't exist. To make the most amount of money, you have to put in work. And so I'm arguing for, in this video, one of the flaws is that they think that the buy and hold proponents, myself being one of them, pretending I'm not one for a minute, believe that by putting in no effort, you'll get the best return that exists. That's just not true. More effort tends to result in higher rates of return. And so yeah, that's just another quick flaw, that you gotta play the defensive and the offensive in your investing strategy. And so that means being open to selling a property that's overvalued. Being open to, another thing is just in real estate, it's just a random aside for real estate. I always tell myself when I'm doing a renovation, even when I built my own house in 2015, most people were getting the upgrades, like the fancy things like speakers in their ceilings and sprinkler systems and things. I didn't do that because I was thinking about resale value. And I always think about an exit. I have 3 exit strategies on every single investment I go into. And I'm making sure that I'm considering what is my exit strategy if I make this decision. If I go and remodel my unit between tenants, how is that going to affect my investment strategy? Is building a shed in the backyard going to have a return on investment? The answer is no, I'm not going to do it. But buy and hold investors will say, I'm going to be there for 30 years. I'm going to build that shed anyway. I'm going to put that addition on, even though the math doesn't make sense, because I'm going to hold this property for a long time. It's okay. I'm going to overpay for this house because I'm going to hold it for 30 or 40 years and I'll make money long term. It's a bad rationale to justify bad decisions. And it makes sense to always be prepared to think, what is my exit strategy? And if that opportunity arises where someone wants to give you top dollar for your property, you should probably sell and then buy something else at a discount. You will continue to refresh your cash faster. The more times you can cycle through your money, the more money you're going to make. So I'm always a proponent of getting the highest return that you possibly can by having your money work as hard as it can for you. And that often means applying a buy and hold strategy and then shifting to an arbitrage strategy and then maybe back to a buy and hold strategy and then maybe into a different value-added strategy. It's okay to say, maybe I'm going to apply a value investing strategy here with a buy and hold strategy. It's okay to sell. Just don't be locked in that, hey, I have to hold these stocks forever, I have to hold this property forever. I'm going to justify bad decisions with that. So that's sort of like the bottom line, I guess, is that the buy and hold strategy is a good one. And if you're new to investing, it's a great way to get started. And it's way better than doing nothing. If you're on the sidelines and you're afraid to go buy some equities like stocks, or you're afraid to buy a property, go ahead and buy something, because buying something is better than nothing. What I'd recommend is do your homework and use a robo-advisor, at least if you're buying equities. And like Wealthsimple is great in Canada, or there's plenty of other ones. Buy exchange traded funds like the Vanguard all-in-one fund. It's basic, it's not gonna give you your highest return, but it likely will give you a better return than if you go and invest without the knowledge to pick stocks, or without the knowledge, even buying a property, without the knowledge to buy the best property. Buying something that cash flows is better than buying nothing. But if you're given the opportunity to sell for top dollar, you should take that opportunity and rebalance. Thank you everyone for watching. I'd love to hear your comments below. Do you believe in the buy and hold strategy? Do you believe that investing should be entirely passive? Or do you believe that you can mix a passive and active strategy together to get the highest returns? Would you hold a property if given 150% of market value for one of your houses? Would you hold it or would you sell it? If you had an opportunity to sell a stock that you knew was overvalued, would you take those gains off the table and then buy something else that is undervalued or not overvalued? Let me know in the comments. And as always, the secret to unlocking a wealthier you is to spend less, earn more, and maximize the returns on the difference. Thank you all so much for watching, and I'll see you in the next episode. And if you found Waldo in this video, I would appreciate the comment. I did wear a shirt that makes me look like I'm Waldo. So yeah, I know I'm gonna get some comments about that. And let's wait for the end of the video to say, hey, you found Waldo, and maybe I won't wear this shirt for a while. Found my Halloween costume by accident. The buy and hold myth. Why the buy and hold isn't the be-all end-all investing strategy. So the buy and hold myth, the buy and hold strategy is full of flaws, and I don't recommend it for all investing strategies. And the buy and hold investing, maybe I'll cut back. I think this will be cut in like within a minute or two, and then we'll cut back to the old footage. Here we go. I'm gonna say a couple more points before I end it. Here we go. How's the audio? Do we test it to see if we're okay? The buy and hold strategy also has a flaw in that it assumes assets and at face value at the buy and hold strategy also assumes that assets do not have different risk to reward profiles. It assumes that, how do I say this? I'm gonna do my outro here. Yeah, I'll leave it at that. That might be a good little intro actually.